So we're going to have some fun today. And the topic at hand here is going to be 10 things to do before December 31st to save taxes planning for or in retirement. So this is for people on both sides of that transition for retirement. It's you still working, maybe you got a few years left. And then also after maybe you've been retired for a few years or longer, what can we do? We got a little bit of everything for everybody here. So should we dive in?
Yeah.
All right. So before we get to the 10 ways to minimize taxes, the other thing on today's agenda are tax basics. So I want to just give you kind of a tax 101 to make sure everybody understands how the taxes work. So we've got in this tax basics section, the marginal tax bracket and the gift tax versus income tax. What are we talking about here? So marginal tax, I want to make something very clear here. Moving into the next tax bracket does not mean all your income starts getting taxed at that higher rate. A lot of people think, oh, I don't want to go to the next bracket because then I'm taxed at 20 or 24% instead of 22. So let's look at this here. So we've got all the numbers. This is 2023 tax year. And you can see in each of these columns, we've got the marginal rate on the very left column. We've got individual income in the middle. And on the right, where a lot of people are falling, is that married couples filing jointly. So you can see that first row, 10%. That's for the first $11,000 of income for an individual, $22,000 of income for a married couple filing jointly. And then once you go over that 11 or 22,000, now you're taxed at 12%. But that first 22,000 is still always taxed at 10%, whether you're, just starting out of college or you're Warren Buffett, and we're talking marginal ordinary income tax here. There's capital gains tax, which we're not going to dive too deep into today. But the bottom line is you look at this 10, 12, all the way up to 32%, and even further, it goes up to 37% right now. It is just on those dollars that are above the threshold.
Yeah. I learned this about 10 or 11 years ago. I was talking to a client and fear struck them. I could see it in their eyes when I said, yeah, you went into like the 24% tax bracket, and they were horrified. And all of a sudden dawned on me, Graham, after 30 years of doing tax returns for people, that the average person doesn't realize that you always go through each of the tax brackets.
Right.
You pay the 10%, you pay the 12%, you pay the 22%, you pay the 24%, and if you have a little bit more income that went into the 32%, it's only that last a little additional that you're going to pay at the rate of 32%. Right. I never realized that the public, I'd say it's 1 in 2. 1 in 2 people think that when they go into another tax bracket that this horrible thing just fell upon them.
Right.
And they just retroactively lost another 4% of their
that extra dollar. Well, and I think 1 in 2 people also think that when they receive a gift from somebody, that they are also taxed on that. And
or if you give, like you say, if whoever receives the gift, they're going to have to pay the gift tax. Gift taxes are on the giver, not the receiver.
They are on the giver, not the receiver. And the thing here is that gift tax and income tax are completely different tax systems. It's apples and oranges. It is completely different.
Well, I would call it more like apples and some kind of exotic fruit that most people have never heard of, because most people don't even understand that the gift and estate taxes they've heard the term, but they have no idea how it operates.
Well, and for the people that have heard of gift tax, or estate tax, this is the one thing they know right here. The annual limit at 17. They think, okay, I can give 17, or I can receive $17,000, but after that, I'm in trouble. I don't even want to know what happens. I can't go above that limit. But what they don't realize is that's the annual limit. everybody, as the giver, we talked about the tax being on the giver, has a lifetime limit. And that federal limit right now is $12.92 million for 2023. So if you give more than $17,000, you don't all of a sudden have to pay a bunch of tax on whatever amount you went over that. It starts to eat into that lifetime limit that you have.
Right. And so you just made a very good point there. The gift and estate tax is only for people who in their lifetime and or at death are going to be giving 12 million or more away,
right.
Or transferring at their death 12 million or more. And if you are, then you got to worry about the gift tax. But if you don't think you're ever going to get there, Graham,
right.
It's somewhat trivial.
It is somewhat trivial, right? So something to know there. And then the last one here is that there is no limit for gifts between spouses. Not especially, but of course you have to be U.S. citizens. If there's another aspect here if your spouse is not a U.S. citizen, but no limit for spouses. If you wanted to pay for somebody's medical bills, if you pay directly to that medical institution, there's also no limit on that. It has to be a qualified medical institution. And the same thing goes for educational institutions. A qualified educational institution, there's no limit of giving somebody money, but it has to go directly to that educational institution for them. So that is gift tax there.
Again,
so
let's just clarify. Gift taxes are on the giver, and they only will apply to people during their lifetime and at death, could potentially give or transfer a combined total of more than $12 million.
Right.
Right.
And there is one, maybe this will be a whole separate webinar, but there is, everything we're talking about here is on the federal side. Now, Maryland does not have a gift tax, but they do have an estate tax, which is, it operates similarly where, like Drew said, when you die, if you leave more than X amount, you can get charged an estate tax. So for Maryland, that estate tax is $5 million per person. A lot more we could go into there, but the bottom line is that if you don't have more than $5 million as married couples, it's not really something that you have to have on your radar.
Sure.
So let's jump into it. That was Tax 101. I hope everybody enjoyed that. So now we're going to go into the 10 things to do to minimize taxes in retirement. And again, this is for people who are maybe a little bit before retirement and people who are a little after. There's a little of everything here. So number one, optimize tax buckets. What does this mean? We've got 3 tax buckets we want to talk through. One is the Roth. A lot of people have heard of Roth, where you pay the tax now and it grows tax-free, and then you withdraw it tax-free. But the thing is, you're paying at your tax rate now. The other bucket is the traditional bucket. That's the pre-tax bucket. So you're getting to avoid taxation initially. It grows tax deferred, not tax-free, but tax deferred. And then when you take the money out, that is when you are taxed. You're taxed upon the withdrawal. And the last bucket here is what we'll call after tax. Now, this could get confused with Roth because that's after tax in a way as well. But the difference here is that you're taxed on capital gains, dividend, interest income every single year. If you have realized the capital gain, if you've received a dividend in an account that's considered an after-tax account, you're taxed on the return in that year, regardless of whether you took the money out or not. So the summary here of the different tax buckets, when we compare Roth versus traditional, is that if your taxes are expected to rise, then you really want to be contributing to Roth accounts. If your taxes are expected to fall, then normally traditional accounts are the way to go. A lot of things to factor in here. It's not as simple as saying, what's my income going to be? There's a whole dynamic in how Social Security is taxed in retirement that can affect this. And then it also matters what state you're living in. If you're living in Florida with Drew, it's very different than if you're living in Maryland with Graham. It's something that you have to look at all the different factors, but this is kind of the summary of those things.
But if you're living in Maryland with Graham and you expect to move to Florida with Drew, it makes a difference too. So
Exactly.
It makes a
Right.
difference where you are already. It makes a difference where you expect to be in the future when you're making that decision.
Right. Exactly.
Make
And
sure
a
you
lot-
talk to your advisor about that one.
Definitely, you have to, because there's so many different intricacies to this. It's impossible to just use a rule of thumb here. So this optimization of your tax buckets, a lot of this has to happen before December 31st. So one of those things for people who are still working is contributing to a Roth 401k. We talked about how Roth, you pay tax now and it grows tax-free. So when you are retired, that is when you really get the benefit. You're taking that money out tax-free. So just like Drew said, let's say you're living right now, you're working, you're in Maryland, living with me here in Maryland, paying taxes, paying income taxes for Maryland. You might want to do a traditional 401k right now. And then when you're in Florida, if you move to Florida and you're taking that money out, now you get to pay no taxes regardless because you're in a tax-free state. Now, if we were in the opposite situation, say Drew missed us so much, he decided he was going to come back to Maryland, he would want to be contributing to Roth 401ks right now. And then when you take it out, even if he's in Maryland, it's tax-free.
So what do you do, Graham? Okay, you go ahead. I got it.
It grows tax-free. It's important to know this is different than a Roth IRA. Roth 401k and Roth IRAs are taxed the same, very similar, but it is a different account. And the big differentiator here is that on a Roth 401k, there is no income limit.
It's amazing how many people think that, oh, I can't do a Roth 401k because my income's too high. That doesn't apply to the Roth 401k. It only applies to the Roth IRA. And if you got good tax people, Graham, you can get around the Roth IRA idea.
Right, exactly. So sticking along with Roths, the next thing here is considering a Roth conversion. This has to be done, again, before December 31st. But what is a Roth conversion? So that is when we take pre-tax money from a traditional IRA or 401k, 403b, traditional accounts, and convert it to a Roth IRA. We're that little goldfish jumping from the one bowl to the other bowl. Well, when you do that, it shows up as income. If we took $10,000 and moved it from a pre-tax account to a Roth account, it is taxable income. So when we're thinking about, well, do we want to pay the tax now or not? We have to look at the buckets. Again, it's about optimizing those buckets. And there's a thought leader in our industry. His name's Michael Kitces, puts together great graphics here. And this is one of them where you look at what bracket you're in. If you're in the 10% to 24% bracket, that can really make sense to do Roth conversions. If you're in the 24 to 37%, you might want to avoid the income. You might not want to do a Roth. But here again, what I'm saying is a rule of thumb. Just as Drew's saying, you have to look at the details. You have to talk to your advisor and see what is the nuances of my own personal situation to determine, should I do a Roth conversion now or not?
Well, so one of the things I wanted to point out is that there are still people out there, believe it or not, who don't have a Roth 401k or a Roth 403b option. Okay. But there's a solution. The solution is you do a conversion. You put the money into the Roth 401k, you put the money in the Roth 403b. I'm sorry, you put it into the traditional 401k or the traditional 403b. So you get that tax deduction, but then you turn around and convert other IRAs or 401ks that you may be able to move to a Roth, and voila, you in essence have just done a Roth 401k or a
Right.
Roth investment, right?
Right, right,
But here's the problem is that your tax withholding will be out of sync
right,
to some degree when you do that. When you do it with your employer, your withholdings are pretty much you've figured it out over the years. They pretty much line up. But when you do a Roth conversion, you have to be prepared to pay the taxes in the future. But what you're talking about here, Graham, is probably one of the most important things that people can do for retirement. And we're going to get into that is Roth conversions, Roth. I've wrote the article and I've talked enough about it. A Roth strategy is critical for every single client.
it is, and it's critical for this next reason here. If you are in Maryland, I feel like we've got a theme going on here, Drew, about Maryland. Maybe we don't want to live in Maryland for tax reasons, but if you're in Maryland, you really, and you're married, we're using married numbers here, you want to stay under $150,000 of adjusted gross income if you are 65 or older. So let's tell you the good news first. The good news is there is actually a new retirement tax credit that came out in 2022 that's helpful. It's not going to change your life, but for a married couple, you can get up to a $1,750 tax credit. So if you are under $150,000, you get that. It's great. I've seen it on many returns. The problem is for the people that go over $150,000. You lose that $1,750 credit. Now, I'm not talking about $10,000 over, $20,000 over. If you go $1 over, you fall over that cliff. Hence this imagery here on the slide. You fall over the cliff. If you go $1 over, you lose that. So we've been talking about Roths this whole time. If you have Roth money, when you take that out, it doesn't show up as income. So that $150,000, you're able to stay under that. Again, there's many things you have to consider, but if you can keep this number, $150,000, and you're over 65 on your radar, it really can be helpful.
Very much so. And Maryland's not the only state that has this kind of garbage, you know? So you got to be prepared for lots of different states.
Right.
They're all trying to come up with gimmicks to get the tax revenue out of people, you know?
Right. Well, and I mean, in this instance, it's a net positive. It doesn't, it doesn't hurt the people who don't get it from the standpoint that they didn't have it before. But it would be nice if there was something a little more logical than just you go over by $1 and you lose $1,750 of a credit.
Yeah, that guy that made $149,999 and the guy that made $150,001, they're in totally different tax worlds.
They're in different tax worlds, right? Not to mention there's Maryland exemptions that also help bring your tax down. You lose a little bit of that if you go over 150,000. So it's a important number to remember, especially if you're in Maryland. So how do we keep this lower other than just taking money out from Roth accounts? Something else you can do is put money into health savings accounts. So let's talk about health savings accounts and why they are the best account that exists. You would agree with me there, Drew, right?
There's no doubt about it. This is the best of the best.
And the reason for that is that we have contributions are tax deductible, just like a traditional IRA. Withdrawals are tax-free, just like a Roth IRA. It's the best of both worlds. And one thing to note is that they're different than flexible spending accounts. A lot of people think they hear health savings account, they think of that account that you use it or lose it. That's a flexible spending account. Health savings accounts, you get to keep forever. It is your money. Now, I talked about how this can help lower your adjusted gross income. This is for people who are really under 65. So if you are over 65, most of the time you're on Medicare Part A. And that disqualifies you from being able to contribute to an account like this. So if you're over 65 and you've got a spouse that's under 65, they can do a health savings account, but you cannot. So this is an account that's mainly for people who are under 65, but at a minimum, it's for people who are not on Medicare.
Great plan.
The other thing that this does apply for people who are well over 65 is something called a qualified charitable distribution. This is for people who are over 70 and a half. So this is, instead of giving money from your bank account to charity, you are giving money to a charity directly from your IRA. It's going directly from your IRA to the charity. And the reason that this is beneficial is that it doesn't show up as income on your tax return. Whereas if you give money from your bank, you have to do something called itemizing. If people are familiar with the standard deduction versus itemizing on your tax return, you have to have more than $25,000 to $30,000 of itemized deductions for a married couple in order for that to even benefit you. Whereas this qualified charitable distribution, you could take the standard deduction and still get a benefit by doing this QCD.
You got to keep in mind too that it's very important. Only an IRA can do this. You leave your money at the 401k or 403b, you cannot use it to give to charity. It has to be rolled over to an IRA.
And this used to be, exactly, and it used to be the ages used to be the same with the required minimum distribution. Used to be 70 and a half, you could take a QCD, 70 and a half, you take your required minimum distribution. But it is now a little different. You can technically do this qualified charitable distribution at 70 and a half, but for most people, the required minimum distribution age is 73. That's where you're really getting your biggest bang for your buck. Because if the IRS says, I got to take $20,000 out of my IRA, that would show up as taxable income. You could say, well, let me take 10 of that and give it to charity instead. And all of a sudden you've reduced your income by $10,000.
Yeah. And look, Graham, I get a lot of people tell me, well, I get a deduction for my charity. I take it as an itemized deduction. Look, I know taxes better than most people know taxes. And let me tell you something. If you're giving money to charity out of your pocket, hoping to get the itemized deduction, you might, but you're still going to hurt yourself because you don't understand how the tax law is now built into that adjusted gross income number. And anything you can do to bring that adjusted gross income down, which is what the QCD does. The QCD, you don't take it as an itemized deduction. That happens down the tax return away. This comes off the top. It's not part of the AGI, Graham. That's why the Roth is also so important. It's not part of the AGI, the adjusted gross income. It's critical. If you're giving money to charity of any reasonable amount, you need to do through your IRA.
Right.
There's no ifs, ands, or buts about it, you know? Now, if you're giving 25 or 50 bucks, you don't want to be bothering your custodian to get a check for $25 to give to your volunteer fire department, right? But if it's $250, $500, if you're giving over the course of the year, $800 or $1,000, you should bother your custodian to make sure that you get a QCD, qualified charitable distribution.
Right. Now, for those that are not 70 and a half, the next best thing can be what Drew's talking about is the itemization. And one of the things that we really like to use to gift in a way that's not through a qualified charitable distribution is something called a donor advised fund. So this is a really cool type of account. And the way that it works is you've got the donor over here and they give cash or assets to the donor advised fund. And when they put the money into the donor advised fund, that's when they get the tax deduction. They can leave the money in that donor advised fund really for as long as they want. There's generally a small fee that the custodian charges, but the money can stay in there. And then over the course of year 1, year 2, year 3, they can give that money to charity. They're not getting the deduction again when they give the money to charity. It's just when the money goes into the account first. But it gives them that control to say, well, I don't want to give, $100,000 all in 1 year, but I might over the course of 3 years. So let me put $100,000 into the donor advised fund now. I get that $100,000 deduction. And then year 1, $33,000. Year 2, $33,000. Year 3, same thing. So this is an account that really gives you a lot of flexibility. And the other thing, not tax related, that people really love about it is that you can give to 100 different charities from that account, and you only need one receipt. One receipt. So instead of getting 100 receipts for your tax preparer to put together the return, one receipt. Now that receipt, whether it's from this donor advised fund or from another charity, it's important that it has certain things on it. So no goods or services received for this donation, number 1. It has to be in hand when you file your taxes. If you give a single gift over $250, it needs specific acknowledgement. The date of contribution and the amount for each check has to be on there. And the last thing here is that if you're giving more than $3,000, it has to be on charity letterhead containing all this information above.
Yes, the IRS is after this. They've won a court case that said if you don't have it in hand when you file your taxes, they can deny the deduction completely, even though it was a legitimate charitable contribution. And they've been using that role that they can show that the taxpayer did not have it in hand when they filed their tax return, and they've denied the deduction completely. And I'm talking about some big deductions, Graham. And they've won it all the way up to the Supreme Court, even though you could prove that it was a legitimate charitable contribution.
Right.
Because they didn't have it in hand when they filed their return, they denied the deduction.
Right. And that donor advised fund just simplifies things, because now you just need that one receipt and you don't have to worry, are all these criteria met for the 50 different charities that you might give to?
Yeah, no, the donor advised fund is fantastic. And you're going to now show us how to really amp up the donor advised fund, right?
Right. So we're going to call this the 1-2 punch. And the one punch was the donor advised fund. It's just giving money to charity. Sometimes you get a benefit for that if you itemize. The second thing is, instead of giving cash, if you give appreciated stock, that's punch number 2. That's where you turbocharge this strategy. And the way that it works is that if you have to sell some stock, let's say you purchased it for $10,000, the current price was $30,000, so you have a capital gain of $20,000 in there. If you're in the 15% long-term capital gains rate, you would have had to pay $3,000. Well, instead, if you give that $30,000 to the donor advised fund, not only do you get the $30,000 deduction, but you get to avoid that $3,000 of capital gains tax as well. And if you really like the stock, you can just buy it back. Take the cash that you were going to give to charity and instead just buy back the stock that you just gifted away to the charity instead. But all of a sudden, you've eliminated that gain, because you're buying it for the price that it's worth today. There is no gain, even though you still own now the same $30,000 of stock. The one thing that's really, really important is that it has to be long-term capital gains here. If you bought a stock and in 6 months it went up 100%, and then you gift it, you do not get the deduction on the fair market value. So you really want to be thinking about stocks you've held on for at least a year or longer, and ones that have appreciation in them, like this example.
You underestimated that too, Graham, because you only did the federal tax bracket 42 states in the country have a state income tax, and they would be subject, for example, in Maryland, that would have been 23.5%,
Right.
not just, so you're talking more like 40, 4,000, what is that? 3% of 20 is $4,120.
Well, and this is I'm even underestimating it on the federal side, because this is for people who are in the 15% bracket. A lot of people, if you make over $250,000, are going to get that net investment income tax onto this. That's an extra 3.8%. And then if you make over, I think it's $500,000, $600,000 now, you also get into the 20% tax bracket. So let's add all these up. You got 20% long-term capital gains, the 3.8% net investment income tax, and then to Drew's point, you got the state tax on there, which could be easily another 7 or 8, depending where you live. So we're talking 30% on this. And if you give it to charity and or the donor advised fund, you don't have to pay a nickel on that capital gains.
Yeah.
So it's a knockout punch.
But there are people that are in the 0% capital gains rate. We wouldn't want them to be doing this necessarily.
We would not. And again, that goes back to, you got to talk to your advisor to say, what's my situation? What should I do? And we found a lot of great opportunities of selling appreciated stock at that 0%. And it's a beautiful thing. So number 9, we're getting away from giving to charity, but now we're talking about giving to family. And the other thing, again, before December 31st, contribute to a 529 plan for grandchildren. So when you do this, you can get a deduction depending on what state you live in. So for Florida, they don't have a state tax. So if you give to a 529 plan, you're not getting a deduction because there was nothing to get a deduction in the first place. But in Maryland, there is a deduction that you can get, and it's $2,500 per beneficiary per parent, basically. So I've got 2 kids, my wife and we could get a $5,000 deduction for my daughter, $5,000 deduction for my son for the Maryland investment account. We could do the prepaid and get another $5,000 for each of them. So we don't need to go too deep into that calculation, but the deduction varies by state. The second thing here is, as I said, most states require contribution by December 31st, Maryland being one of them. There are a handful of states that technically this December 31st deadline does not apply, but for all intents and purposes, you really want to have this done before the end of the year. And the last thing, this is new, there is a new rule that says you can move money from a 529 plan to a Roth IRA for that beneficiary, but there's a lot of stipulations around it. So number 1, it has to be a 529 plan that has been open for 15 years. So there's a lot more into that you need to talk to your advisor about, but this is, again, just another flexible addition to the 529 plan. You put this money in when your grandkids are young, you get that 15-year clock started, and even if they don't go to college, there are other avenues to use this money.
Yep.
Last but not least, tax efficient investing. Can't tell you how many tax returns we see where there are so many different types of investments that could be really the same investments, but just in a different location, and it would work out much better for the client. So let's look at this. So tax efficient investing in retirement accounts. What would we put in retirement accounts? Funds with capital gains distributions and income generating investments can make a lot of sense in retirement accounts, because if you think about it, capital gains distributions at the end of the year, if it's in a Roth IRA, if it's in a traditional IRA, it doesn't matter. Because if you remember the very first slide, the way Roths and traditional accounts get taxed is not about what's happening inside of it. It's about when you put money in or when you take money out. Whereas after-tax accounts, brokerage accounts, this capital gains distribution, this is where the December 31st aspect comes in. You will see that at the end of the year, a lot of funds will distribute these capital gains and you have no control over it. So all of a sudden you've got this big tax liability on your tax return because it was in a, maybe the wrong type of account. Whereas non-retirement accounts, maybe having some tax efficient exchange traded funds or municipal bonds in those types of accounts can make a little bit more sense. So Drew, from a retirement account, non-retirement account standpoint, anything to add here?
Well, the non-retirement account, let me give you a big one. I can't tell you how many times our clients have no idea what we do for them to minimize taxes, because if you own mutual funds or ETFs and they're planning to do a distribution, and you can find out a month or two before December, you can contact them and say, what are your plans for a taxable distribution this year? And they'll say things like, we're planning to send out 15-20% of the net asset value in capital gains, because that's the way they work. If they've sold things during the year and they have gains, then at the end of the year, if they don't have losses to offset it, they have to distribute it out to the shareholders, who will then pay taxes on it. Well, we say, no way, Jose, we don't want to do that. That doesn't work for us, So we then turn around and sell the fund and figure out our own way to reduce the taxation. And if we still like the fund, we might buy it back after the distribution's taken place. But you have to be very careful about that when you own mutual funds, ETFs. You need to know what their distributions are going to be. And if there are planning strategies that you should be implementing, you'll be seeing us do this in the next few weeks, actually. We're actually in the process of doing this right now for some of the funds we own, because we're like, we're not taking this. We're not going to sit and pay taxes on this. So that's definitely something to think about, Graham.
It is. And there's a lot to think about here. So just as a recap on all the things that we went over, number one, optimize tax brackets. 2, look into the Roth 401ks if you're still working. 3, the Roth conversions. Stay under $150,000, particularly if you're under, if you live in Maryland.
That's if you're married.
If you're married and you live in Maryland.
And $100,000 if you're single.
$100,000 if you're single. Qualified charitable distributions, it's for people over 70 and a half, especially if you're 73 and you're having to take those required minimum distributions. The health savings account, tax-free in, tax-free out. It is the best account that exists. Number 7, donating stock so that you have, you don't have to pay the tax on that capital gains. Doing that in concert with possibly a donor advised fund. Again, it just means you only need that one receipt and you have the control over when you get the deduction and when you give the money away to the charities. Number 9, that 529 plan contribution for your grandchildren. And number 10, tax efficient investing. This is by no means an all-encompassing list. There's countless other things that people can be doing, but whether you are close to retirement or recently retired, there's a number of things on here that you really want to be considering. So the question is, as we've said this whole time, how does this impact you specifically? If you're already a client, please reach out to your primary advisor, make sure that you understand what you need to be doing here. And number 2, if you are interested in becoming one, you're not a client, feel free to go to our website, financialconsulate.com. You can even scan that QR code and you'll be able to schedule an intro meeting if you have a couple of questions on what it's like to work with an advisor like us that really dives deep, not into just investments, but also the tax side. You have to be considering the entire picture there. So with that, Drew, any other last words?
No, but I think that's such a critical point, is that the investments are pretty standard where people do their asset allocators. They put money in the S&P 500, the international, the small cap, the bonds. There's not a lot of variation of what investors are doing in the financial world, right? It's the tax planning, it's the comprehensive planning. That's where the difference is made. And that's what that's what the consulate is dedicated to do. So few people in this industry are trained in the tax planning and so forth. And so it is critical. And that's this was a great introduction to some of those strategies that we use. And there's so many more.
There are. And we thank you all for attending. If you know anybody that would benefit from seeing this webinar, feel free to share them. And with that, we'll see you next month, where we'll have another webinar in November. Take care.
All right. Thank you, Graham.